Hello students, this is our third video in the series National Income Accounting, and in this video we are going to discuss certain basic concepts which are required for conversions to solve the problems on national income accounting. So starting with the first basic concept, net factor income from abroad. In order to study this concept in detail, let me first take you to the concept of domestic territory and normal resident that we have discussed earlier. Domestic income of a country is income earned within the domestic territory of the country, be it a resident who is earning this income or be it a non-resident who is earning this income. Whereas national income is income earned only by residents of the country, be they are located within the domestic territory or they are located outside the domestic territory of the country. Thus, in order to convert domestic income to national income, we need to add income earned by resident located outside the domestic territory of the country, and we need to subtract income earned by a non-resident who is located within the domestic territory of our country. Explaining it once again, let's say that residents are earning 50 plus 50 plus a non-resident is earning 30 within the domestic territory of the country. In that case, our domestic income will be 130. Now let's say that a non-resident located outside is earning 50. So our national income will be 130, which is domestic income, plus 50, which is earned by a normal resident outside the country, minus 30, which is earned by a non-resident within our country. Thus, it will be equal to 150, and difference between 50 and 30 is 20, which is net factor income earned from abroad. Thus, net factor income earned from abroad is difference between factor income received from rest of the world by our normal residents minus factor income paid to rest of the world, that is factor income earned from abroad minus factor income paid abroad. Now, what do we mean by factor income earned from abroad? It is the income earned by normal residents of our country from rest of the world, as we have seen just now. And what do we mean by factor income to abroad? It refers to the factor income paid to normal residents of other countries within our economic or domestic territory. Thus, by subtracting factor income earned from abroad, that is income earned by our normal residents who are located abroad, minus factor income paid abroad, that is income paid to non-residents who are located within our domestic territory, we get NFIA or net factor income from abroad. Now, what are the components of NFIA? There are three main components of NFIA. Net compensation of employees. It is the difference between compensation earned by normal resident of our country from abroad and compensation earned by non-residents located in our domestic territory. Net income from property and entrepreneurship. Again, difference between rent, interest, profit and royalty earned by our normal residents from the outside world minus similar payment made to non-residents from our domestic territory. Net retained earning. It is the difference between undistributed profit of resident companies abroad and foreign companies located in our domestic territory. Thus, by adding these three, we can get NFIA. Now, NFIA can be positive, negative or zero. It is positive when income earned from abroad is more than income paid abroad. That is, our normal residents from abroad earn more than what we pay to non-residents from our domestic territory. It is negative when income earned from abroad is less than income paid abroad. That is, our normal residents from abroad earn less than what we pay to non-residents from our domestic territory. It is 0 when income earned from abroad is equal to income paid abroad. I hope the concept is clear to you, and it is very vital to distinguish between the domestic income and national income. A numerical example to clarify it further. For example, normal residents of India temporarily living abroad earn 25,000 crore in the form of salary, rent, interest or profit. And similar payments were made to rest of the world equivalent to 20,000 crore. In that case, NFIA would be 25,000 minus 20,000, which is equal to 5,000 crores. It is positive as income earned from abroad is more than income paid to non-residents working within the domestic territory of the country. Coming to the second important concept, net indirect taxes. Value of goods and services can be estimated in two ways. Firstly, it can be estimated at the factor cost, or it can be estimated at the market price. Briefly, the difference between factor cost and market price is net indirect tax. In order to explain it in a better manner, first let's understand what do we mean by factor cost and market price. Factor cost refers to payment made by all producing units to factors of production for rendering productive services. It is called factor cost because it is the cost to the producing firm towards the factors of productions. Whereas market price is the price at which a commodity is sold in the market. It is the price what buyers pay for the commodity. Market price is sum total of factor cost plus net indirect taxes, and this is the concept that we are going to study now. Market price is more than the factor cost by the amount of indirect taxes made by the consumer, whereas if some goods are sold at the subsidized rate, in that case market price will be lower than the factor cost. Thus, we can say that market price is equal to factor cost plus indirect taxes paid by the consumers minus subsidies received. And the difference between indirect taxes and subsidies is known as net indirect taxes. Thus, we can say that market price is equal to factor cost plus net indirect taxes, where net indirect taxes are indirect taxes minus subsidies. Usually net indirect taxes are positive, that is, usually indirect taxes are more than subsidies, and thus market price is usually more than the factor cost. A quick recap: market price includes net indirect taxes, whereas factor cost does not. Factor cost becomes equal to market price when net indirect taxes are added to the factor cost. In the absence of indirect taxes and subsidies, both market price and factor cost are going to be same. So, MP or market price is equal to factor cost plus net indirect taxes. If net indirect taxes are positive, that is, indirect tax is more than subsidy, in that case market price is going to be more than factor cost, and vice versa. A numerical example: if rupees 200 crore indirect tax has been collected by the government, whereas 50 crore has been given as the subsidy, in that case net indirect tax is going to be 200 minus 50, which is equal to 150 crore. In this case, market price will exceed factor cost by rupees 150 crore, which is equal to the net indirect tax. Last concept, gross versus net investment. In previous classes, we have studied about the concept of depreciation, which is normal wear and tear of the machinery during the course of production. Now, gross investment refers to total expenditure on buying capital goods over a specific period of time without deducting the depreciation. On the other hand, net investment considers depreciation and is calculating by subtracting depreciation from the gross investment. For example, if this is the gross investment and this is the amount of depreciation, then by deducting depreciation from gross investment, we get the net investment. So a quick recap. Net factor income from abroad, it's factor income earned from abroad minus factor income paid abroad. Market price is equal to factor cost plus net indirect taxes, where net indirect taxes is equal to indirect taxes minus subsidies. Last, net investment, which is equal to gross investment minus depreciation. These three concepts are very important in order to understand the numerical part of the chapter. I hope they are clear to you. Thank you and have a good day.